I'm Dennis Tubbergen. You are listening to Retirement Lifestyle Advocates Radio. Glad you decided to listen in today. Hey, joining me in segments 2 and 3 of today's program is the founder of the Financial Survival Network, Mr. Kerry Lutz. I'll chat with Kerry about his view for the U.S. economy and his prediction for gold, silver, and we'll even talk some cryptocurrency in the next couple segments. Stay tuned for that. Also, if you have not yet requested your special report, now available, it's titled Tax-Free Retirement Income Strategies. There has never been a better time to get this information in your hands. Income tax rates are set to increase in 2026 if Congress does nothing, and there are some planning opportunities that are available to many taxpayers over the next couple tax years, that being tax year 2024 and tax year 2025. If you'd like to learn more, go to requestyourreport.com. Let me know where to mail your tax-free retirement income strategies report, and I will be very glad to do so at no cost or obligation. Again, go to requestyourreport.com. You know, if you have been a longtime listener to the radio program, you probably recall me talking about the Dow to gold ratio. In fact, if you go to retirementlifestyleadvocates.com, you can get a free login and you can read my weekly Portfolio Watch newsletter there for free. And in that newsletter, every week, I quote the Dow to gold ratio. Now, as I have stated many times here on the program, I've long believed that to get an accurate measure of the true value of stocks, you have to take a look at stocks measured in something other than the U.S. dollar. As I'll talk about with Kerry Lutz in the next two segments, a dollar that is being devalued skews the real valuation of not only stocks, but real estate and economic output. In other words, the same devalued dollar that causes you to pay more for groceries at the grocery store also means that the value of stocks and real estate and economic output are inflated, but only inflated because the metric or the measure one is using, in this case the US dollar, is devalued. The advantage to measuring the value of stocks in gold is that an ounce of gold has not changed in 5,000 years. Now, if you take a look at the Dow Jones Industrial Average, as I record this, it is just under 40,000. And if you take a look at the price of gold per ounce, it's just under 2,500. So that means the Dow to gold ratio, if we take the value of the Dow and we divide by the price of gold per ounce in dollars, we get a number that at this point is slightly more than 16. So to put that another way, it takes 16 ounces of gold to buy the Dow. Now, if you've been a long-time listener to this program and been on the air now for about 15 years, when I first started this program, one of the first analysts that I interviewed was Mr. Ian Gordon, and Mr. Ian Gordon was the founder of the Long Wave Group. And Mr. Gordon did a lot of work with this indicator. And ever since it's been introduced to me, it's something that has made a lot of sense to me. In fact, it makes so much sense that, as I said, I now track this indicator weekly. And if you look at the Dow to gold ratio, it doesn't dramatically change week to week. It is more of a long-term indicator. Now, David Skarica, who's also a past guest here on RLA Radio, recently wrote a piece that echoes how I view the Dow to gold ratio. Now, here's what David writes. He said, one of the oldest and longest term ratios when it comes to gold is the Dow to gold ratio. The ratio simply states that when it takes roughly 1 ounce of gold to buy the Dow, it is time to buy stocks and sell gold. Now, I would take a bit of exception with this in that that is an extreme, but certainly at that extreme, Skarica's observation is dead on. Now, in 1932, after the initial decline in stocks at the beginning of the Great Depression, the Dow to gold ratio reached 1. In 1980, it also reached 1. At that point, the price of gold per ounce was $850, and the Dow was also at 850. 850 divided by 850 gives you 1. That means it's time to buy stocks. And certainly, 1980 was the beginning of a massive 20-year bull market. You'd argue maybe even more than 20-year bull market in stocks. So 1932 and 1980, this ratio has hit 1. And as Skarika states, both of these times, we had generational lows for stocks. Now, when you look at a chart of this Dow to gold ratio, and obviously a chart is very difficult to talk about on the radio, but I plotted a chart in the Portfolio Watch newsletter that I published on August 12. Again, you can go to retirementlifestyleadvocates.com and see the chart. And if you go all the way back to 1932, you see this ratio reached 1. The same thing happened in 1980. Now, at the top end of the chart in the mid-60s, we saw the Dow to gold ratio reach something north of 25, call it about 27. That means it took 27 ounces of gold to buy the Dow. And from 1966 to 1980, that ratio dropped from about 27 to 1. Now, starting in 1980, we saw that ratio go from 1, and it didn't top until about 2000 at about the tech stock bubble peak, and it was about 44. So when you take a look at this Dow to gold ratio, ever since the dollar has become a fiat currency, we have a series of higher highs and a couple of lower lows. That means that as the dollar became more of a fiat currency, this Dow to gold ratio has reached more extreme values. Now, I fully expect that we will see this Dow to gold ratio get back to 1-to-1. Now, I have been saying that on the program here for about 10 years. And keep in mind, I realize that you may be listening to this and saying, wow, 10 years ago, I heard you say the same thing. And yet the Dow to gold ratio has moved from maybe 21 or 22 to 16. It hasn't moved that much. And it has oscillated between those 2 points over that time frame. If you're thinking that, that is absolutely the case. However, this is a very long-term indicator. Going back to 1913, there have been 3 highs, with each high being higher, and there have been 2 lows. So this is not an indicator that moves quickly. It marks long-term turning points. So the question is this: if the Dow to gold ratio gets back to 1, and the Dow and gold have the same value, at what point do they meet? Well, that's the question that really no one knows the answer to. If the Federal Reserve creates currency, if we have inflation or a highly inflationary environment, is it possible that the Dow could maybe go to 20 or 30,000 and gold to do the same? Certainly it could. In a hyperinflationary environment, could they both go to 1 million? Well, there's an outside chance that that may be the case as well. But my point is this: when you take a look at the Dow to gold ratio, it presently favors gold more than stocks. Now, does that mean that stocks are going to go down from here? Not necessarily. Does that mean that gold is going to go straight up from here? Again, not necessarily. However, over time, it's my strong view in looking at this ratio that if you are a long-term investor, it's important to have some gold in your portfolio. Because again, an ounce of gold has not changed in the 100+ years that this indicator has been around. Now, when you take a look at the levels of government debt, now over 35 trillion, when you take a look at government deficit spending, which is now about 2 trillion this year, you have to assume that the Fed's going to have to go back and they're going to have to help to subsidize the deficit spending of the U.S. government. And if they do that, it means that that will likely be bullish for gold, at least nominally speaking. Now, again, I'm going to be back after the break with my special guest, Mr. Kerry Lutz. I'd encourage you to stay tuned for that, but let me remind you, if you'd like to get the tax-free retirement income strategies report, you can do so by visiting requestyourreport.com. I'll be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Kerry Lutz. If you are a longtime listener, you recognize Kerry as the founder of the Financial Survival Network. You can learn more at financialsurvivalnetwork.com. I'd encourage you to do that. Kerry interviews some of the brightest minds on the planet, and he is a prolific content provider. So check it out at financialsurvivalnetwork.com. Kerry, welcome back to the program.
Hey, it's an honor to be here with you, Dennis. It's so interesting in these days of mass media here. Anybody who could pick up a microphone or turn on a webcam considers themselves to be an authority or a media person. But listening to your intro of me, I realized that, hey, us radio people really do have the advantage in this medium here.
Yeah, for sure. And your Financial Survival Network has grown to be huge. Our program, through all the sources, more than 100,000 listeners a week. So it just tells me people are looking for the truth and people are looking for a different perspective. So I appreciate all your work in that area as well. Let me jump in if I could. We have the SOM indicator that is triggered. We have an inverted yield curve now flattening. We've got the Fed talking about rate cuts. Are we in a recession?
Well, arguably, we've been in a recession, but, when you keep changing the goalposts and, say, well, 2 quarters of negative GDP growth don't mean anything. I mean, you could make the argument we've been in a recession for years and just look at the deficit and everything else going on. So, yeah, we're in a recession. But I guess, as always, the U.S. is the best looking house in Baltimore, right?
So, Kerry, you mentioned the deficit. I'd like to just a couple follow-up questions on that. First of all, when you take government deficit spending and imagine for a minute that we have a balanced budget, GDP is negative. So isn't it just fair to say that this last 4 to 5 years have been nothing but a prosperity illusion, if you can look at today's economy and use the word prosperity?
Well, maybe for you and I, it's an illusion, but people out there in the middle class who are really getting slammed by inflation, and let's face it, the way the government measures inflation, if they were fitting you for a suit, you would wind up having a toddler's suit by the time they got done with it. It's really tough out there. And so many of you out there are working 2 and 3 jobs, DoorDash, Uber, just to try to make ends meet. And, it always comes down to the economy, stupid, right?
Absolutely. And, Kerry, what's your take? I mean, I just read a story that 76% of all personal tax revenues now go to pay interest on the debt. There has to be a reset. So I guess my question for you is, how much longer can this crazy spending trajectory continue? And what does the reset look like in your view?
Well, my friend Nick Santiago, who's a master trader and a really wise person, always says the trend is your friend until the end. And look, it's like it'll go on until it can't any longer. Something has to be done. We're not like at the point where we could just say, oh, let's cut a few departments and cut the budget. I mean, the budget's got to be cut by 50, 60%. And there's just no way to do that without a revolution. So in the end, it's going to come down to a jubilee, in my opinion. And basically it's going to be all debts are going to be forgiven. Now, obviously, the existing financial system can't continue on like that because your debts are their assets, and their debts are somebody else's assets. So the debt's got to be dealt with one way or the other. All recessions, depressions always come down to debt in the end, and the debt's got to be liquidated. It's not going to be paid. We know that, but when you start saying, well, that nice Social Security payment that you've gotten used to here, that's going to go down by a third or 40%. People are going to freak. So it's got to be some type of deflationary depression where all of these things just collapse. I mean, look at the housing market. I love real estate. It's been a great performing asset, but all of the mortgages being made, or 90%, are being bought by quote unquote investors that are the big banks that are really buying on behalf of the Fed or Freddie, Fannie, whatever you want to call it. So, this debt cannot continue onward. Debt can't increase geometrically. Well, at best, GDP growth increases incrementally, at best, if it's really increasing at all, which we could debate that as well.
Well, a couple things, Kerry, based on what you just said. I mean, we talk about GDP growth. We measure GDP in U.S. dollars. The U.S. dollar is not gaining an absolute purchasing power. So isn't there an argument to be made that, GDP growth as measured in U.S. dollars is really more of a function of dollar devaluation than it is real economic growth?
Yeah, well, I always like to say, when Bernie Madoff, when things were going great, he was a positive contributor to GDP. And then all of a sudden, one day, he became a negative. The GDP is not a true measure of wealth. It's a measure of dollars making their rounds. And, without the proper inflation deflator and the taking into account debt, when you and I were kids, $1 of federal debt could produce $6 or $4 in economic activity. Now I think it's getting to the point where increasing debt will actually decrease productivity and wealth creation.
So, Kerry, you use the term deflationary depression. I certainly agree that we're going to have to see a severe deflationary environment. And I think a lot of Americans maybe haven't quite gotten there yet, but when you look at debt as a percentage of GDP or economic output, in 1929, I think it was around 140% of economic output, private sector debt. It's now about 220%. And the government wasn't broke in 1929. So doesn't this deflationary period of time, depression, whatever term we want to use to describe it, doesn't this have to be more severe than what we saw in the 1930s just by looking at the data and looking at the numbers?
Yeah, well, our economy bears no resemblance to the economy in 1929. It's global in scale, supply chains, all that. And back then in 29, a lot of people still lived on the farm, a large percentage. There was still some self-sufficiency. Now there is no economic self-sufficiency. And nobody's more dependent upon the supply chain than I am. Yeah, I've got my emergency food. I've got my self-defense mechanisms in place. But nonetheless, the supply chain collapses. We are completely helpless. And there's absolutely nothing that we can do about it except band together with our community and try to find a way forward. So this is going to be bad when it happens. But, it's like the big one in California, the big earthquake. It might not ever happen during our lives, but every day that it doesn't happen makes it more likely that it's going to.
Well, if you're just tuning in, I'm chatting today with Mr. Kerry Lutz. He is the founder of the Financial Survival Network. You can learn more about his work and see his interviews at financialsurvivalnetwork.com. Kerry, just a few minutes left in this segment. You talked a bit about housing. We have mortgage interest rates back. We'll just call them around 7% or so. And when you listen to maybe some of the younger households out there that are trying to buy a house and they say they can't do it because interest rates are far too high. In the whole scheme of things, we're really, probably near average mortgage rates. So how do you see this playing out as far as housing? Are you seeing a big decline moving ahead, or how do you see it playing out?
Oh, it's so interesting, man. It's like, hey, there's two tiers in this market, like in Florida. There's over a million where people basically are buying for cash, and then there's like the mid range in that 3 to 6 or 700,000 where they still use mortgages. So in the upper tier, it's not slowing down at this point, but in the mid tier, those people are getting hit. The house that you can afford with 7% interest rates is like less than half. And myself, look, I have like a 3% mortgage, and my mortgage is an asset, my 3% mortgage, because every year I make money on paying back the bank in deflated dollars, devalued dollars. So real estate has to be hit. But it's a question of if it's a crash. There's one thing I see that I believe might be the white knight. I think when you go back to the 90s, we were headed in exactly the same direction here. We didn't have as much debt, but then we had the internet, and the internet revolution changed everything. It really did. And, we had the boom in the internet stocks and all that. That was a lot illusory, but it made us way more productive. Many of you out there, maybe not all, but I think it rescued us from the situation we're in now. Now we're looking at AI. And my only question is, it looks obvious where everything's heading, but what impact will AI have on it? If the real cost of everything to produce due to AI goes down 70 or 80%, and, we're able to think our way out of this situation through AI, because that's how we have to solve problems, right? We think our way through it. We're confronted with a crisis, we're confronted with a problem, and then you come up with a solution. So AI could be the silver bullet that stops the world from collapsing, or it could be the final nail in the coffin that causes a major collapse. I don't know yet. Yogi Berra used to say, we're talking about quotes, prediction is very hard, especially when you're dealing with the future.
On that note, the clock says that my first segment with Mr. Kerry Lutz has come to an end. Check out Kerry's work at financialsurvivalnetwork.com, and I'll continue my conversation with Kerry Lutz when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I'm chatting today with Mr. Kerry Lutz, who is the founder of the Financial Survival Network. You can check out his work and check out his many interviews with some very bright people at financialsurvivalnetwork.com. So, Kerry, we talked a little bit about housing. Certainly no shortage of volatility in the stock market over the past couple of weeks. We see that we had a big down day. What are your thoughts? Are we seeing the beginning of a correction here, or is this just a little blip?
Here's the thing. The rest of as much of a mess as this country is, the rest of the world, for the most part, is way, way worse. And if you look what's happening in China and, in Europe, nobody trusts their banks there. I mean, we might be losing faith in the system, but we still go to bed at night thinking, all right, my money's safe in Bank of America. It's safe in JP Morgan Chase, Wells Fargo. And we wake up the next day and our money is there. In China, that's not the case. The banks kind of disappear. They don't really have a safety net. Not that ours is going to work if it's a mass failure, but ours still works to some extent. And so if you have your choice, put your money in the bank in China overnight, or in Deutsche Bank in Europe or whatever, or in the U.S., you put your money in the U.S. All that flight capital's coming here. That's why the dollar has been so resilient even though it's gone down recently, it hasn't gone down that much. And you look at that and you say, well, if everything collapses, the US can't not collapse. But until that point happens here, the stock market's going to keep going up. And because, look, you're a big corporation, you can't, or a big fund, you can't put your money all in gold. It's impossible as a practical matter. And the only place where you can really go is into the stock market. So the volatility to be expected, a little surprising. We don't usually have crashes in the summer. We usually wait till the A team is back from the Hamptons or from St. Bart's or from the south of France. And then they look at everything and they say, oh my God, sell. And, we could easily see crashes, but crashes are changing. Like we're having March crashes. Didn't usually have March crashes. It was September, October. I don't think what happened in the past week quite qualifies as a crash. It's a mini panic, a mini crash. It's like in Florida here, we have hurricanes, but then during the summer months, we have these mini hurricanes, these storm cells, tropical depressions, whatever, and they hit hard, but not like during hurricane season. So that's what I kind of see what's happened here. And let's face it, this is election time. I don't really like to talk about politics because you do have a family show here. But, it's I remember late publisher of the Wall Street Journal, Alan Abelson, editor, I guess he was. And he used to say the Fed is doing what it does best, which is getting the president reelected. And that's what they're working on right now. So they can't afford to have any sustained crash. After the election, all bets are off.
So, Kerry, a couple things there. We will get on the political road in a second, but I wanted to get your take. We saw the big decline in stocks, largely have recovered as we're recording this, although still a lot of volatility. Much of this decline in the market was blamed on, the evaporation or at least the weakening of the yen carry trade. To what extent do you think that is the culprit of what we saw, or is that just a convenient excuse?
It's so interesting you bring that up because less than 1% of the population understands what the heck the yen carry trade is. I've been following it, like you. It's been around since the banks collapsed in Japan. They created the carry trade so that they could borrow money there much cheaper, invest it in T-bills in the U.S., and that's how we backdoor bailed out the Japanese banks. Okay, so it's a very complex topic. I'm kind of repeating myself, and I can't say what it is. I just want to bring up one possible conspiracy theory because I love conspiracy theories, and I know you do too.
Well, I said, as we talked before we get on, the difference between a conspiracy theory and reality is about 6 months.
Yeah, and remember where they came up with that term. They're trying to, revise history, revisionist history, but you and I both remember the CIA coined that term after the Warren Commission report on JFK's assassination was released. And they said anyone who didn't believe it was a conspiracy theorist. And I have a T-shirt that says, I identify as a conspiracy theorist. My pronouns are told you so. And so let's go back to 08 and 09. McCain versus, and I promised I wasn't going to talk about politics, but this is more fundamental than that. McCain versus Obama. We had this collapse during the tail end of Bush W administration. And it was found that there were massive withdrawals from money market funds, which basically seized up the economy, caused these massive financial collapse all over. Not that it wasn't going to come. All right. It was definitely coming because the real estate market was unsustainable and most of the mortgages at that time were worthless. So what happened? Supposedly these hedge funds triggered it in an effort to forward the candidacy of their favorite candidate. What if what we're seeing now is a similar thing, but they're coming down on the side of not the Democrats, but the Republicans. Now, I have no proof of this. I can't prove it, but we do know that the hedge fund industry mostly is now backing Trump. The problem when you trigger these little crashes is you don't know where they're going to end. And I don't think they had any idea when it was precipitated in '08 and '09 what was going to happen to the global economy. I mean, right down to pension funds in Finland, right? In Scandinavia, they were affected by our housing crash. So maybe that's what's happening now. Maybe it's a taste of it, because when people are scared, that's anti-incumbent. Now, I'm not saying I have any evidence or anything else. It just seems to me this is an analogous situation.
Interesting perspective, Kerry. There's an old saying, I think, also, since we're full of quotations and cliches today, that watch what they do, don't listen to what they say. And in that vein, we have central banks around the world that are continuing to accelerate the rate, for the most part, overall, at least collectively, at which they're buying gold. These are the same institutions in charge of managing the fiat currencies of their respective countries. So, what should the average listener read into that?
All right. So that is a really great point. Yeah, judge them by their deeds, not their words. And, when you see them going into gold, what are they thinking? I mean, it's a barbarous relic, right? You have to pay to dig it out of the ground, and then you got to dig a hole, build a vault, and store it in the ground. Obviously, their faith in the underlying financial system is dissipating, is diminishing. How much so, we don't really know. We haven't really seen the pile into gold, but gold's almost at $2,500 the ounce here, Dennis, and that is, whole numbers from an investor technical standpoint don't mean anything. But from a psychological standpoint, 2,500 is a huge number. And you see regularly when we get to that point where these numbers are broken or about to be, a lot of hanky-panky takes place, right? A lot of raids, a lot of activity in the futures market happens. We were just about to cross over it yesterday, the day before, and magically gold gets hit. So, kind of diverging a little bit from your question, but I think that that everybody knows, the Titanic has hit the iceberg, and everybody knows it, and the band is playing, and people out there are saying, "Oh, but that cello is out of tune, man. You got to fix that." And I think that's where we're at now, and that's what the central bank buying is telling us. But again, it could be a year, it could be 10 years. The other thing is, economic historians, there's a guy named Bob Hoy. I don't know if you ever had him on your show. If you haven't, you should. Canadian guy, he's traced back economic panics for hundreds and hundreds of years. And what happens during these panics is the reserve currency always becomes more valuable because it's the last man standing. So while they're buying gold and gold is going up in nominal terms, it's nowhere near what its purchasing power has been in the past. $32, so it's up 80 times now, roughly, almost 80 times. But the dollar is worth maybe 1% of what it was back when gold was $32 an ounce. So maybe it should be 3,200, 3,500. It's the ultimate insurance policy.
So, Kerry, in the time we have left, do you like silver more than gold, or do you like gold more than silver?
Man, you keep asking me these hard questions. I like the portability and the compactness of gold, but silver is the people's, gold is the king's money, the money of royalty. Silver is the people's money, and copper too. So if things function properly, and let's not forget, Gold is trading at or near its all-time high. Silver is trading at 60% or less of its all-time high. If you believe what Eric Sprott says, $300 silver. Silver has got its allure, it definitely does, but I'm bullish on both, and copper too.
Well, I concur. And the clock says, Kerry, we're going to have to leave it there. Let me remind the listeners that I've been chatting with Kerry Lutz. He is the founder of the Financial Survival Network. You can learn more at financialsurvivalnetwork.com. And I encourage you to do that. Kerry, thank you for joining us today. I always appreciate your time, and I'd love to have you back down the road for an update.
Likewise, and looking forward to having you on our show too, Dennis, and be well.
I will. Thank you so much. We'll return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen, and thanks again to my special guest, Mr. Kerry Lutz, for joining us on this week's program. If you're just tuning in and you have not yet requested the special report that I'm making available, it is titled Tax-Free Retirement Income Strategies, and it's yours by visiting requestyourreport.com and letting me know where to mail the report. Again, the website is requestyourreport.com. In this segment of RLA Radio, I want to talk a bit about what's been going on in real estate. Now, there's no amount of data manipulation, and I'm talking about the official inflation rate calculation, that changes reality. Even though the official inflation rate is a rather innocuous, seemingly controlled number, we know that the real inflation rate is higher than the officially reported inflation rate known as the Consumer Price Index, because the Consumer Price Index, or the CPI, is adjusted for hedonics or pleasure, there's substitution, and there's weightings, and these are manipulated to make the published inflation rate seem more palatable. The reality, though, is the Federal Reserve easy money policies that have been pursued over the past 4 years or so have created inflation. And on top of that, the trade deficit, brought about largely by increasing energy dependence over the past few years, also adds fuel to the inflation fire. Now, this easy money policy by the Fed has really affected housing in particular. Past guest here on RLA Radio, Mr. Mish Shedlock, recently commented that if you look at a home that sold for $150,000 in 1988, the mortgage payment was $1,076 per month, and that's with a mortgage rate of a little bit more than 10%. So here we are in 1988, $150,000 home had a mortgage payment of just over $1,000 a month, assuming a 10% mortgage interest rate. Now, that same home in 2006 was worth about $403,000. The mortgage payment on a $403,000 home was about $2,000 a month because the mortgage rate declined to 6.52%. Now, the same house at the end of 2020 would have cost you $502,000. However, because interest rates were held to an artificially low level, the mortgage payment was now $1,600, 20% cheaper than when the house was priced at $100,000 less. So when the house was worth $400,000 and mortgage rates were 6.52%, the payment was $2,000 a month. And 14 years later, even though the house sold for $500,000, the mortgage payment was less by 20%, about $1,600 a month, even though the house was selling for $500,000. Now, if you fast forward to right now, that $150,000 home that you'd have bought in 1988 would set you back about $707,000. Your mortgage payment today, $3,662 at a mortgage rate of 7.06%. So we have seen since 2020 mortgage rates go up from 2.68 to about 7%, and the mortgage payment more than double for the same house. Now, it's actually worse than I just described, because these payments do not include often property taxes or insurance costs, which are escrowed. Those costs have also gone up. Now, Ms. Shedlock makes the point that this mess is entirely of the Fed's making. And it's what happens when the Fed and economists in general do not count home prices as inflation. What does that mean? Well, home prices are not directly included in the inflation calculation. Rising home prices do not make the consumer price index or the reported inflation rate go up. Economists, those compiling the consumer price index, consider home prices as a capital expense, not a consumer expense. The problem, though, is that inflation is not just a consumer price concern, it also affects capital expenses. Now, existing home sales dropped 5.4% in June. It was the 23rd decline in 29 months. So you cannot refute the fact that home sales are falling. Home sales right now are about where they were in December of 1995 and May of 1979. However, as I talked about with Kerry Lutz on today's program, only price-insensitive buyers can really afford to buy a home. So it's those that are buying the higher-end homes who are paying cash, or those that have cash because they just sold their previous home. Those seem to be the only buyers that can afford to buy. In fact, the stats bear that out. All cash sales accounted for 28% of all home purchase transactions in June. So since January of 2020, the official inflation rate as measured by the Consumer Price Index has prices up about 21%, yet over that same time frame, housing costs are up more than 52%. Therein lies one of the flaws of the Consumer Price Index when measuring the actual inflation rate. It's never been more important to reduce taxes, and that's the subject of the report that I'm offering this week. It's titled Tax-Free Retirement Income Strategies. You can get a copy of the report by visiting requestyourreport.com. Just let me know your name and address, and I'll be glad to mail you a copy. Again, the website is requestyourreport.com. Also, lots of free resources at retirementlifestyleadvocates.com. I'd encourage you to check that out as well. That's all the time I have for this week, but I'll be back again next week.